Our next guest says investors should lighten up on gold and buy more crude oil because the risk of a global economic slowdown is overstated. We'll take a look at our chart of the day. It shows that 1 ounce of gold buys just over 22 barrels of oil. That is the most since March of 2009. Well, Jim Paulsen is chief investment strategist at Wells Capital Management, where he oversees about $340 billion in assets. And he says if investors play that spread between oil and gold, they should be pretty happy 6 months from now. Well, Jim joins us from Minneapolis, Minnesota. He's a frequent guest here on Fast Forward, and always a pleasure to have you, Jim. Good to see you.
Good to see you, Lisa.
So I will say I think you're pretty optimistic as it relates to the health of the U.S. economy and the ability of our financial system to work its way out of its problems. But you're not so optimistic on the Fed necessarily taking any action. And we're going to get to oil and gold in a minute, but I do want to start there.
Well, they may well come out with a QE3, Lisa. They may well do that. They may well announce it here at Jackson Hole. I'm kind of hoping they don't. I don't think what we need now is more liquidity. I don't think we need lower rates. We got plenty of both. What we need is a show of confidence among our leaders. The market's medicating itself here with what it needs. It's dropped mortgage rates. It's increased the money supply. It's dropped the dollar. It's dropped energy prices. What we need from the Fed is a show of confidence. And that starts with them saying, look, we're not here to respond every time the market whines. We're here to watch the economy, and we think it's okay right now. It's slowed, but we think it's going to do okay. If it worsens, we'll respond, but we're not going to respond simply because the stock market's dropped 15%. And we need to move away from a trend we put in place back when we introduced TARP in 2008, that every time the stock market falls, a policy official jumps to their aid. I think that's a bad precedent, and I'm hoping that we move away from that.
So with the understanding, of course, that the economy is the underpinnings to all of these asset classes and the way they're trading, connect the dots for us a little bit between that, your prior comments, and your thoughts on oil and gold.
Well, the oil and gold potential trade is just one of many, I think, that are available to investors today as a result of this market panic. And the basic theme that we're focused in on is safe haven assets versus cyclical assets. And across every market, what you see is a wide valuation differential that's taken place. Within the commodity market, for example, the safe haven gold and precious metals have gone way up, whereas the industrials or crude oil have suffered. And the relative value now favors crude oil or copper well over gold. Within the bond market, certainly high yield or investment grade bonds offer much greater yield now relative to high quality treasuries. And within the stock market, everyone's running for the safe haven of steady eddy consumer staples or utilities, and they're dumping in cyclical industrials and technology. And I just think in the portfolio as a whole, to move a little away from safe haven and a little towards cyclicality when the relative value differential is so great makes a lot of sense.
Jim, how long does it take for this investment thesis, though, to be realized? 6 months? So you'd be selling out of gold, buying oil, or reducing positions in gold and adding to those in oil, going from sort of the risk-free to the risky assets overall. You know, what if the Fed does come out with a QE3? Does that change everything?
Well, I think that if the Fed comes out and announces QE3, I think there will be a rally in risk assets, Lisa, at least in the short term. Longer term, that might not be as good, but in the short term, it'd probably start that process sooner. I have no idea in the short-term timing here. Gold could continue to go higher as long as this panic continues to burn. I just think we're getting close to the end of this mini panic. I'm hoping that the stock market is finding a bottom here around 1100. But I just think once a bottom is found, and if the economic data reports over the next 6 to 8 weeks remain relatively okay, even if they're not super strong, I think greed is going to return to the financial markets. And if it does, people are going to start dumping safe haven assets and start gobbling up more of the cyclical oriented. Whether that takes 2 months or whether it takes 6 months, I'm not real sure. But I think for investors that have a longer horizon, 6 months to a year, I think they'll be happy if they made some allocations away from safe assets today.
And Jim, quickly on the Treasury market, everyone's talking today about how the Treasury market is pricing in a QE3 or a good 50% chance of a QE3 before year end. What happens if there is no QE3? Do you think we do see a big unwinding in Treasuries? Do we see prices plummet and yields go up?
Well, I think that we'll have some reaction in both markets. If there's no announcement this week throughout Jackson Hole about a potential QE3, then I think that we'll have some downward trading in both markets. But I think the market can handle it and we'll come out of it okay. The Treasury market probably won't have as big of upward rally in yields as you think, simply because I think those yields went down more, Lisa, because the Fed said they're going to keep rates low till 2013 than they are because of an expected QE3. So I'd say those rates are down for a different reason.
Yeah, I would agree with you on that, Jim, but a lot of people this morning seem to have reassessed over the weekend, now talking about a pricing in or very, very slow economic growth. Well, on the topic of just economic growth, let's talk GDP for a moment. Are your forecasts coming down for the year, or at least for 2012, perhaps?
Well, I think probably, not so much for 2012, but for maybe this year. I was thinking we'd accelerate the second half to 3.5%. I think that's looking more like 2.5 to 3 now, but I do think we're going to get a bounce. And the reason for that is because I see the market, as I mentioned, medicating itself. There are reasons to be optimistic here. We've had a huge drop in mortgage rates, a big surge in the money supply, a big drop in energy prices. We've had a drop in the dollar, all of which should help stimulate the economy. I'm also impressed by how well the consumer's hanging in there. Retail sales have been good. The retail stocks have held up really well through here. They're not suggesting a recession at this point. So I'm still hanging in around the 2.5 to 3% reacceleration in the second half and more like 3.5% in 2012.
All right, 3.5% 2012. Jim, always a pleasure to have you. Thanks for joining us. We got to leave it there. That was Jim Paulsen of Wells Capital Management. A little more optimistic on the economy, perhaps, than most people we've heard from, at least this morning.